So let's back up for a moment and talk sort of big picture about the federal tax system and how it works, basically.
Right. So I can try to bore everyone to death with technical terms. There's an unlimited number of technical terms. I've been doing this for over 16 years and still run into new terms. So I'm going to skip a lot of those right now. At the most basic level, you start out with your gross income, which is all of your income from any source. This includes your salary, but also profits from the sale of stocks or real estate, gambling winnings, all sorts of income. Once you start making adjustments, you wind up with your adjusted gross income. So your adjusted gross income is after your what they call above the line deductions, but before the below the line deductions. Below the line deductions bring you to your taxable income. If you're thinking about above the line deductions, that would be something like a contribution to a health savings account. And then below the line deductions are itemized deductions, which is what most people think about, like medical expenses, state and local taxes, and charitable deductions.
Okay. I feel like one term that probably everyone has heard in relationship to taxes is the word bracket. Maybe not everyone listening is totally confident about what that actually means. So what is a tax bracket?
Right. So we have a progressive tax system that taxes higher brackets of income at higher rates. So when you have more income, it's getting taxed at a higher rate. However, the important thing to remember here is that not all of your income is taxed at your marginal tax bracket rate. So the highest tax bracket right now is 37% for married filing jointly couple if they're making around $694,000. So let's just take an example. A married couple making $800,000 would be in that 37% bracket, but only about $106,000 of their income would be taxed at that rate. The rest of their income would be taxed at lower rates, the same rates that you and I probably are incurring. You need to fill up each lower bracket before spilling into the next bracket. So while it's still a very large tax bill for a married couple earning $800,000, the overall effective tax rate is closer to 28% rather than their marginal rate of 37%.
So you're basically filling up each bucket with dollars. And then once you get to this certain threshold, that's when they start getting taxed at the next highest rate.
Yeah, it's like you hear people and it's like, oh, I got bumped up into the 37% tax bracket. It wasn't even worth making that last $10,000 because they think that it's now 37% on everything, but that's not how it works.
Besides income level, are there any other factors that determine how much federal income tax someone owes?
So I think a lot of people think that bonuses are taxed at a different rate than other income, but that's a misconception as well, because there's different withholding on bonuses. They might withhold a higher percentage of your bonus as federal income tax, but it's not actually being taxed at a different rate. It all evens out at the end of the year. The most common income that's taxed at a different rate is qualified dividends and long-term capital gains. And both of these are taxed at 15% for most people, 0% for lower income individuals, and 20% for high income individuals. And then there's also the 3.8% net investment income tax, which applies to investment income over a certain threshold. And this would be income from dividends, annuities, royalties, rents, passive activity income, and most capital gains. But like I was saying before, bonuses don't get taxed at a different rate. It's not like they're penalizing bonuses.